Okay, welcome guys to the autumn webinar series. So we've got 7 webinars coming to you over the next 7 weeks or 6 weeks after this. So this is the first one in the series. So today we're actually going to be covering where to make money from property post-COVID. Okay, and really what I'm trying to do with these webinars and what I'm trying to do with the guys I've got on and that is really create the big picture, but then also break it down into what you can do and the action steps you can take. And I think that's really important right now because there's so much stuff going on. There's so much garbage, out there in terms of, trying to steal your attention and trying to tell you that things are going this way or things are going that way. And I think, what we're going to try to do here is give you a really good understanding of the bigger picture of what's going on and how that influences you as a property investor. And more importantly, what we're going to try and do is give you a level of certainty that actually you can take action, you can move forward, and you can make things happen. Okay, so guys, I really want to welcome you along. I want to encourage you to comment if you've got any questions. Type them into the chat. We're actually on the webinar. We're on live stream. We're on Facebook. We're all over the place right now. So we're all over the place. Hopefully, I can get all the comments coming in, and then we'll be able to address them. I've got some really cool guests on here today that I've been working with for over 10 years, in fact, now. So I'm really impressed with that. But look, guys, help us out. And if you haven't already, make sure you subscribe to the channel. And any questions you've got, you can either email them into webinars@gladfish.com, or if you're watching the live stream right now, then simply type them into the comment box, whether that be on YouTube, Facebook, or wherever. And I should be able to chuck them on screen, and we can answer them as we go through, because I want to make this really interactive. And I think, between the three of us, there's not too many questions that we can't answer about. And sure, there's opinion, but there's not too many questions that we can't answer about the property market now or where we think it's going. Okay, there's 3 words that really we'll talk about, and I'll talk about in a minute. And I think that's really the theme for what we're doing today. So let me start off by introducing Ritesh. So Ritesh and I have been working together. Hey mate, how are you?
Hey, good.
Yeah, excellent. So Ritesh, just explain what you do, what your role is, and yeah.
Yeah, so look, I'm Ritesh. So I've been working in the industry, working with Brett pretty much since 2009. My role in the business is pretty simple, actually. I sit down with clients like yourselves every single day and sort of walk them through this complex web that property investment can be when you start the journey. It's not really that complex, but when you do start it, many people like you to think it is. And the idea is to give you the picture on a macro level and micro level. So macro level in the sense, talking about the bigger picture of the market itself, how the whole market is tying in with the economic cycle. And the micro level in the sense that let's get into which are the right areas, which are the right developments, who should I be working for, where should I be buying? So covering those both, answering questions, and just getting you to a position where you have enough transparency, enough information to be able to confidently take that next step, whatever that is.
Yeah. I think he was trying to steal some of my job there too, actually, but no, all good. Cheers, mate. So he's got a wealth of experience and sitting down with clients, strategizing and planning them, talking about the market, all that sort of stuff. That's the bread and butter of what Ritesh does, as well as running the entire London office that we've got there. So for our next guest, it's Dan. So Dan, how are you? So do you just want to bit of an introduction?
Yes. So I'm Dan. I'm the portfolio director here. I started here just after Ritesh, January 2010, so nearly 11 years. And my day-to-day role is to work with investors at all levels to kind of sit down with them, work out where they are now, where they want to be, and ultimately help them with 2 main aspects: strategy, structure, and then build it all into a plan. So the strategy side is, what's the most effective based on what's practical for you and where you want to be. And the structure side is also very important because that is structuring it in a way where you can kind of withstand short-term blips and make sure that we're kind of setting up so you're de-risking yourself as much as possible.
Yeah, awesome. Yeah, good. So look, guys, we're going to kick off. And look, I think today and in fact all 7 of the webinars, I've put them together to give you that level of certainty. But actually, there are a lot of concepts. Unfortunately, our industry is such that we're constantly talking about house prices and interest rates and all this rubbish and garbage. And sure, that's an important part, yeah? But the reality is there's so much more to what's going on that if we look into and can tap into some of these big changes that are going on, then we can actually put ourselves in the best position to move forward, So, whether it be COVID or recession or disruption, so the three words, I guess, we've talked about here, which are pretty much, we're looking at recession, disruption, and predictions. Okay, and look, we got no problem. I just realised I'm in the wrong spot there, haven't I? I haven't set the camera up properly. But no, look, those three words are really the theme for this whole 7 things. Okay, so we're going to be covering a lot of disruption and what that means too. We're going to look at the recession, and we're also going to look at the predictions in both those aspects. So I think that's really important. And what we're covering today, you've got the reception, disruption, predictions, you've got the problem with returns, okay? You've got the alternatives to, if you don't want to do buy to let or you don't want to do property, then what else are you going to do? Because I can tell you, it's not looking very favourable in any direction right now. So a lot of people are saying buy to let's dead. Well, the reality is, what do you go to? So we'll look at that. We'll look at the dynamics at play. We'll look at overcoming the recession next sort of 12 to 24 months when we're, either going to be in recession or COVID before we get over that sort of hump. And then we're going to look at the disruption side, because I think, look, if you want to get me started, get me on over a few beers or whatever, then disruption is one of those things that will just get me talking all night and won't shut me up. Because I'm reading so much about it and I see how it is actually starting to come to fruition in that. And then we'll look at predictions, experts, but more importantly, and I think this is the last one, which is what you can do next. In other words, what actions can you take now to, ride some of this disruptive change and opportunity that comes through it? Because at the end of the day, opportunity is where it's at. Yeah. So as much as I said, this house prices and that sort of stuff is not something we really want to focus on right now, but the reality is it is something we want to look at. And I think one of there's 2 daunting decisions that I see you guys facing right now, which is number one is what's going to happen with house prices. Yeah. And your options are, your decisions are to sit around, and not do anything, procrastinate effectively. All right. And for me, practically, that's never really resulted in, success in a portfolio, okay? Short term, maybe, but not long term. You could buy and actually the prices could go up, okay? There's people predicting that. Certainly in London, we're seeing some predictions come out and the fundamentals are there. But then you've got buy and, it sits around stagnant. 80, 90% of predictions are there. And then you've got buy and it drops. And the interesting thing is with the drops, there's less and less of those, but they are there. So you've got to decide where that house prices fit. If you look at 2020, and this is where we start talking about experts, and how badly do they get it wrong? Well, Bank of England fall to 16%, 13% down. 10 to 5 to 10, 7, 5, 10, 7, 7, minus 6, 0.6. So all of these experts predicted 2020, but yet we're looking to be up 7% at the end of the year, which is extraordinary, I know. But the reality is that's because of the government initiatives that have happened. But, the reality is you've got to factor those in now, because that is fiscal policy is something that is there. It is a tool that can be used and it has been used. But the interesting thing that you've got to note, and this is one thing that I look at all the time. Look, this is 2020, 2024. So this is some other predictions. This is from Hamptons. But you can see the 4-year forecast, a lot of people are saying they're going to get going up. So the house price dips, most people are saying it's 2021, yeah? They're not necessarily saying it's 22, 23, and 24. Most people in that case are saying, showing it's up. But look, the bottom line with this whole game is that most experts are wrong most of the time. Sorry, I just stuffed that up, didn't I? I got to get the right camera. That's the problem with having too many cameras. Look, guys, most experts are wrong most of the time. And the reason I say that, and the reason I say it so many times, is because unfortunately, as human beings, we look and we're growing up to look to experts, from the schoolyard teacher, all these sort of things. We're used to listening to those people. Now, the challenge we have is that, we take that into the world, and we take that into the world of property investment, and we end up in this situation where, we listen to stuff that isn't right and turns out to be wrong, and we make decisions on that. So this whole series is about giving you the ability to make those decisions for yourself and to do the research yourself. And I think, that's really, really important, okay? So I might as well throw my hat in the ring, because let's face it, what would I be if I'm not making some predictions? Look, my predictions for 2021, I reckon prices will drop around 3%. Yeah, not drastic, but I do think they'll either rise 3% all the way down to minus 10%. So some areas are going to see drops, and they'll be the ones that make the headlines. But then other areas I think aren't that bad. All right, and let me bring the other boys on. So what do you guys think about that? Any thoughts on what you think? House prices for next year?
It's an interesting one. I'm sort of sitting, I've got a wider range here. I'm sitting between 0 to 10. So either nothing can happen, it could drop by 10%. And look, that 10% drop might mean it drops 15%, or that 0% in that region. And the reason why I'm, even though a lot of the news coming out and all the COVID situation should mean that we have a price drop. I mean, I remember back in 2009, 10, when the global financial crisis.
Mate, your mic's gone all funny.
Oh, is it?
Do you want to check your mic? Let me guess, it come out.
Is that any better? Sorry.
Yeah, that's better. Yeah.
So I'm going to repeat that because it's really important stuff. I'm going to go back to 2009-10, global financial crisis, when a lot of places, well, most places in the UK were dropping in price. London, not dropping as much, but still dropping. But yet places like King's Cross, Islington, Brett, you must be aware, you had a place in Islington, was still going up, which is ridiculous.
100%.
It's ludicrous. How can an area go up in price during global financial crisis? But it was.
Yeah, and I think one of the interesting things is if you look at London, the house prices, they dropped for 6 months and everyone said, oh, London, blah, blah, blah. And then they bounced straight back up and then they continue to grow, and look at them now. They're doubled in price. I mean, we'll show you some stats later on. It's incredible, that side of it. But so look, so house prices is one thing, and we can go into lots and lots of statistics and all that sort of stuff, but to be fair, that really gives you the summary. Most people, to be fair, I've got comments on my YouTube of people saying no, they're going to drop 20 or 30%. London, is devastated because everyone's moving out, there's going to be no one left in the city and all these. It's just not how it's going to play out, but we'll talk more about that as we sort of build some depth into that sort of thing. But let's have a look. The other side of it is, because obviously there's the capital growth side, and house prices. Yes. But the other side is the interest rates. So if we have a look at the interest rate side, the daunting decision you face is with interest rates is you do nothing, in other words, don't invest, or do you buy and then they increase to unaffordable levels, 10% of people are predicting that. In other words, there's so much liquidity going into the market that has to result in, capital increases, or interest rate increases. The other side of it is that they gradually increase over time, which is by far the majority, including all of the lenders. If you look at their interest rates and where they're predicting over the next sort of 10 years, that's the case. Or that we have, where they stay low for a long period and we have this real period of stagflation almost. Or the other side of it is they drop further. Now, the point with dropping further, I don't actually think, even if they drop further, and I know the Bank of England's talked about negative interest rates, that's not necessarily going to mean that you're going to get negative interest rates. Because just because the banks are getting them doesn't mean you're going to, okay? So don't, hold out hope for that. It's not necessarily going to happen, all right? But, that's the sort of the issues you've got with the interest rates. Any thoughts on interest rates, guys?
Well, I mean, from the conversations that we're sort of having with a lot of the mortgage brokers in the industry, because they obviously speak to underwriters and lenders and all that kind of stuff, is that it's a situation where, look, no one sees rates going anywhere quickly whatsoever, because it simply can't. There is a case right now where, depending on what structure you're buying under, because some of the lenders might have closed their books for a short while just to assess what level of risk they're willing to take on and stuff. The competition sort of dies down. So when there's not enough competition in the market and there's fewer lenders, then you'll get the odd naughty lender, I call them, who will try and make bigger margins and charge a little bit more. But we're talking about really small amounts. So actually, from an interest rate perspective, it is a great time to get involved in property. I mean, we've been spoiled over the last 10 years of where the interest rates have been sitting, and everyone's sort of got used to it. But even with a slight rise, they're an awesome place when it comes to interest rates, in my view.
Yeah, 100%. And I think that the reality is when you've got uncertainty, lenders tighten their belts. You know, I used to I set up a mortgage company in Australia, and I was heavily involved in that. And so I used to be an underwriter and approve loans and those sort of things. And, you know, if it started to look a bit shaky, we would close up our books, you know, or we, you know, clamp down on the sort of fringe lending and just go back to core. And what happened when that uncertainty went away and it becomes certain, then we'd open it back up again. So this is natural, you know, and of course they want to price in the risk. That's natural for them to do. You know, it's not the case. The other side is we've had Brexit, you know, Brexit layered on top of austerity, which means that most of these lenders haven't been doing massive volumes. They got a big volume of lending come in. Well, they don't necessarily have the money to lend, or they don't have the people to underwrite it. So it's totally expected to be what's been going on. Hey, we've just had a message in from Simon. So I'll just leave it there. I'll come to it a little bit later, okay, because it'll fit in well a little bit later on. But yeah, you know, so the interest rates, most of the predictions are that interest rates are going to stay low, that they're not going to, certainly in the next, you know, if you look, you know, out 10 years, even 10 years, that they're not going to jump up to like 15% or 10%. And I don't think the market can handle that. So I think low interest rates are here for quite some time yet. All right.
Yeah.
So let me ask you this. So what happens now? So basically, you know, and this is one of the big things we're finding is people saying, oh, I'm not, you know, it's too risky buy to let. I just don't know where it's going. I don't know what's happening. You know, what else? You know, there must be something else to do. What's the alternative? And, you know, the reality is, where else are you going to make return? I mean, if we look at just purely countries that you can invest in, UK, US, Spain, France, Poland, Romania, Aussie, New Zealand, Singapore, South Africa, et cetera, et cetera, et cetera. And we can list off any country there. The reality is they're in the same boat that the UK is in, or whichever country you're listening to is in. You know, this is not like it's just happening to one country. You know, the reality is, it doesn't matter which country you go into. There used to be a play where I would say, right, I'll, you know, invest in Australia now because the Australian market's booming. I'll do UK now. Now, actually, to be fair, they're both in exactly the same situation, and so's the US and so's Spain. You know, and yet house prices can still be going up. So there's still things happening, but the reality is, what we're finding is, you know, you can't escape to a different country. All right, we'll talk about one of the you know, major disruptions, you know, disruptors soon. You know, about with that point too. And I think that's really important. The other side, you know, if you look at, you know, what other things can you do? But if you're not going to do property, you know, what about business? Well, you know, your current career, could you change career? You know, invest in a startup or a more established business, do online marketing, physical products, you know, fulfilled by Amazon type things, a side hustle, you know, become an Instagram, although it's TikTok now, you know, influencer. You know, there's so many options, but they all come with the time commitment, the risk, and all this sort of stuff. And I think that's what, you know, you've really got to realize is, what is your actual alternative that isn't just going to create another job for you? And maybe it is a side hustle, maybe it is another job that you want, which is fine, you know. But for me, property still offers, you know, a huge opportunity. You've just got to know how to do it, you know, and as I say, the strategy to meet the market. And I think when you understand that and when you apply that, and we'll talk a bit more about that, don't worry, you know, but I think that's important. You know, let's look at other stuff, because, you know, let's take pensions or, you know, shares investments and things like that. You know, pension funds, I mean, where are they investing? They're investing into property. They're investing into, you know, that's one of the big things they're investing into. They're investing into shares, and shares are investing into business or property, you know, and they're all in the same boat. So, you know, it doesn't matter where you look now, what you're starting to find is that you have this issue where, you know, where is your capital going to go? And you can sit it there and sit it in the bank as cash, but you know what, with such low interest rates, you're not making any money. You know, and inflation, I mean, inflation's not as much of a problem right now, but the reality is you're going backwards if you're sitting in the bank. So, you know, the question really becomes one of, should I invest, you know, in something? I mean, let's look at maybe a bit, you know, more of left field. You know, in terms of alternative investments, you know, hotels, students, wine, land. I even saw investing in solicitors who then use it to sue people, you know, forests, you know, carbon credits, all these sort of things. I mean, you know, hotels have been decimated, you know, students have been decimated. Some of the stories coming out now, you know, even some of the Airbnbs and things like this, you know, they're just not what they used to be, and they're really coming under. And the interesting thing is, for the most part, while all these other investments have been falling by the wayside, actually, your bulk standard buy to let has been consistently performing. And yeah, you may have seen a drop in a rent because your place had lots of service apartments, or you may have seen, the area actually has boomed, but the rent hasn't kept up, or maybe that the prices have boomed so much that actually not much is happening with the prices. But the reality is the principles that worked 20 years ago or 25 years ago when I first got in, and that worked 10 years ago and worked 5 years ago still work today. And I think that's really important. So yeah, and look, so let's just move on from there. So there's, for me, one of the challenges you've got to face is, if not property, then what? Yeah, and I think that's one of the challenges that you have. If not property, then what can you actually invest in? Because as far as I can see, there's not too many options unless you know exactly what you're doing and that, So yeah, so good. So, somebody said can't hear anything. Sorry guys, let me just check. I don't know why I can't hear anything. Yeah, sorry guys. I just realized somebody, it's working. Yeah, okay. It looks like my mic for some reason is not coming through on here. Let me try and turn it off and turn it on again. The joys of technology. Yeah, can't hear Dan and Ritesh. Why can't? So apparently you can hear, but can't hear Dan. I don't know why.
Oh. Can you?
Is it not working?
No, it's not.
Seems to be a problem with the webinar chips.
Is it?
So apparently, if you jump onto YouTube, it seems to be fine, Brett.
Guys, if you jump onto my YouTube channel, which is YouTube/C for channel /Brett's Property Rants with an S on the end. So Brett's Property Rants. I'm not sure what's going on, but it sounds like YouTube's fine and the Facebook's fine, but for some reason the webinar software is not working, or it's not working for someone. So we sent the
link in the chat box, so everyone should have the link for the YouTube channel in the chat box.
Yeah, perfect. Okay, good. Yeah. Yeah, okay. Yeah, cool. Okay, well, sorry guys, the joys of technology. But yeah, I guess, we've been doing the YouTube and that for a while, so sorry about that. But we'll have to go back and watch it anyway. I'm going to continue on for the guys that have been watching on YouTube and that. And yeah, apologies to the guys on the webinar. I'm not sure what's been going on there. But anyway, yeah, and I can see lots coming through now. Yeah, so maybe we've lost it somehow. Anyway, don't know. It looks like it's here, perfect here, but so jump on YouTube. Yeah, it's only on the webinar. Yeah, so okay, great. Okay, so let's continue. So yeah, if not this, then what is the real problem? So let's have a look at, for me, the 5 disruptors, if you like. The 5 factors that are causing disruption to a property investor, and I'm talking about here. So the first one for me is, protection versus globalism, all right? And what do I mean? We've had this period where we've grown and we've, globalized everything, and now the whole world is actually, it's basically there and, talking and all that sort of stuff. But what's happened now through Trump and what they're doing, and it's not just Trump, it's where things are going, as the US sort of winds down its power, and we'll talk about that soon, but, it's polarizing. And what it's doing is basically getting to the point now where I think you're going to have to choose China or the US. And so the world is going to turn into this big Cold War with, effectively, it won't be a cold war, it'll be a firewall, and that firewall will either be use China or you use the US. And really, countries will have to choose, because the US is going to like you using China, and China's not going to like you using them. So I think, that's one of the key things for me that's coming up, and a big disruptor, where, that's going to become more and more of a problem, because even you've got right now you've got lots of Chinese buying in London, you've got lots of Chinese buying all around the world. They're becoming much more of an influence, okay? And that will play out. So that's one of the big disruptors, because from software to everything, they're now having an influence. Whether it could even be down to food production and food supplies and all this sort of stuff. The US was the world leader, and if you think post-World War, they set up all these institutions that served them, and now those institutions like UN are becoming less and less powerful. And arguably the US didn't just set up, so yeah. But look, so Disruptor 2. So the Disruptor 2 for me, is worldwide tax equalisation. And I'll say with exceptions, okay? And the reason I say worldwide tax equalisation is what's happening now is, if you live in the UK and you're just reading the UK news, you could think, wow, this is terrible. Capital gains tax has gone up. The Section 21, all this, not Section 21, Section 24 tax. All these sort of different taxes are being levied, as well as compliance, as well as this. But that isn't just happening in the UK. We're seeing the same things in Aussie, in New Zealand, in fact, all countries, because what's happening now is the globalization of tax, they're all starting to, want their thing. And let's face it, most countries are inefficient at running the country, so their requirement for more and more funding is going up and up, yeah? So that is a challenge, but it's something that really is starting to play out. But what it will mean is that a lot of people say, I don't want to invest there, or what the other side of it will be, if you want to invest into a different country where you're not a citizen or not a resident, I'm Aussie, and yet right now I get treated like everyone else if I want to buy property in Aussie. Yeah, that's just how it is. And in fact, the UK laws are moving in exactly the same direction. And the challenge is, I'm in Singapore and I'm resident in Singapore, but the Singaporeans don't see me. They see me as because I'm a PR here. But anyway, that's what's happening, tax globalization. So Disruptor 3, yeah, world recessions, all countries at the same time, yeah, and there are exceptions, of course. But what we're finding is with globalization, yeah, what's happened is that this country, it used to be this country, went into a recession, and then this country went into the recession, so you could shift your funds from here to here, and avoid that sort of thing. But now everybody's going in together, and everybody's, linked. So if this one goes down, this one goes down, give or take. So it'll be in the little differences that you find opportunity. Okay, so that's a big one. I think now we're starting to see where now the world, the previous recession and this recession, everyone's gone in together. Now some countries avoided it, sure, and that will always be the case, but not in the same way where we used to have, that was if you went into a recession, it was totally independent. Yeah. Disruptor 4 is Brexit and the breakdown of the Eurozone. Now, this is a bit of my prediction. I think, look, Brexit, I think what's happening is that, Brexit's happening, obviously, and I think they will get a deal, but the deal will be such a terrible deal that, you might as well call it a no deal. But they will politically say they got a deal, last, 11th hour deal sort of thing. And I say the breakdown of the Euro because my concern is I think it's dysfunctional at its core. I think there's some really good parts to it, but I think in terms of serving countries, I just don't get it, okay? And so, but look, some of these things can last 40, 50, 100 years. But, there's over 200 different type of Eurozones being created over the last couple of hundred years. There's Norwegian ones, there's all around the world, these sort of trading blocks. So it's not uncommon for these things to rise and then fall. And I think that's what we're going to start to see is, if UK comes away and actually does okay, which it has so far, then actually we could, see other countries going, what, we really don't want to be part of this anymore. We're going to break away. What are your guys' thoughts on Brexit?
Brexit, Dan. About it? Dan, that's not
How long have we got?
before he hears the word.
Yeah.
Any thoughts?
Well, I actually forgot about it because of everything that's been going on.
Yeah. It has been.
I actually, look, with Brexit, it's interesting because we've been in this period for the last 4 years, has it been? Something like that, where the biggest
4 years
for everyone has been Brexit, So before COVID came along, all our clients, everything, before we were doing anything, everyone was worried about Brexit and wanted to know the effects of Brexit and how that's going to map out. The answer to the question was always, who knows?
Yeah.
You know, who knows? You know, we saw it as something which was going to be played out over a while because no one's going to, people are going to, Europe didn't want to show their cards. You know, it's a business negotiation that was going on, okay? But what we did find is all the scaremongering articles which said, the day, as soon as the day Brexit's announced, prices are going to drop off by 20%. I saw some ridiculous figures. None of that actually really happened. Yes, there was small corrections because the uncertainty of Brexit meant that people's general confidence in the market wasn't there, which is always going to take down the transaction volume, and prices slowly did come down. But in some areas, again, nothing happened. Some areas actually carried on going up. So it was not end of the world. It is what we felt.
No, and I don't think it will be either. I mean, it's interesting. If you look back at my videos on Brexit and my book on Brexit, I actually played it pretty straight and got it pretty correct all the way through. And because I just think there was so much media hysteria about it. But we're getting to the point now where we'll be a potential no deal, not no deal Brexit, whatever, pretty soon. Certainly, it certainly looks like it's going to be a no deal Brexit. That's for sure. But I think they will get one politically more than anything. But yeah, so we'll see how that goes. So Disruptor 5, which is the macro risk, and I think that if you look at big picture, what we're looking at is US losing power status, and I think that's going to be the next 20 to 50 years. So they're slowly going to lose it. They will still hold it for a long time yet, but the other side of it is losing their reserve currency status, which that could be more devastating for them, because right now, and I think we're in a period now where the US has been able to print as much money as they wanted, which has enabled them to do whatever they want. To have the largest army or military by massive amounts and to wield that power however they want. But what's happening now is a lot of countries have gone, they're doing it, why can't we? And so they've started to do that, and there's some massive, massive money getting printed. In fact, the money supply, I was reading that actually up until before COVID, the money supply increased 30%. So all the money in the world up until just before COVID, we printed 30% more, which is just unprecedented. That's never happened before. Now that could mean a massive sting in the tail, but for me, I think part of that it was required, and I think actually it was the right decision to do at the time. But is it kicking the can down the road? My concern here is that actually the US did massive, fiscal stimulus back in the last recession, and they continued to kick the can down the road. So their public debt is ginormous, but they got away with it, and they've had growth all the way through to here. So I think a lot of countries are looking, going, what, if they can do that, perhaps we can do that. Maybe not on the same scale, but that's where we're kind of looking now. Now, just one point, I'll just, why didn't we mention technology as being a major disruptor? And look, yes, okay, it is on an individual basis, but the reason I said I didn't put it in as a disruptor is because actually for me, a lot of that is going to make efficiencies and be good for us actually, and good for the consumer, good for investors. It makes the availability of data, because let's face it, technology is old hat almost. Now it's all about how we can use data and AI and things like that. And I think that will really, that'll disrupt industries, but not necessarily us as individuals as much. And I think that's, for me, look, we're already dealing with the technology. I think it's now the big data that's really going to make the changes. But technology has been around, and actually, if you look, my phone's now 2.5 years old. And I had the chance of upgrading the other day, and I was like, I don't need it. The facilities aren't that bad. My laptop, I update that sort of every 2 or 3 years now, and not because I need to, not because it gets any slower really. It's just because it gets to the point where I wear keys out and start to wear things out through overuse. That's because technology for me is a done it's a done deal. I mean, certainly software platforms, AI, that's where I think is the real changes are going to come. So that's part of the problem, guys, or that's the problem, if you like, is if not property, where do you put your money? And if not now, when? So what we want to do now is build on the solution and what you can do, and the type of things you can make. And I think, and I'll bring the guys in too. So have you got any thoughts on solutions or any thoughts on, big picture? I mean, what's your experience in, because obviously you guys have lived through the past recession, and the aftermath of that. And, coming into, we're living through a recession right now. It's a bit of an extra, I won't even say it's not extraordinary in that it's the same as every other recession. It's just different. The name changes every time. So yeah, any thoughts?
Yeah, I mean, it's interesting. Like you said, Brett, I've worked through the sort of last recession and seen how things transition from, when things are really bad and down and people's emotions are sort of a little bit all over the place with what's happening to what happens when things start to slowly improve and then go into a real growth cycle and sort of come out the other end. And for me, look, when it comes to investment, it's impossible to pick the bottom of the market. I would challenge anyone. You go and try and pick the bottom of the market. Anyone can do it when something happens. Hindsight is a beautiful thing, sort of, as they say. You can't pick it. I rather focus on things in terms of the strategy on what I can pick and what I can control. And as an investor, what I would say to you guys is that what you can control is to set your portfolio up in such a way that with things like recessions and prices going down and all that sort of stuff, your portfolio can withstand it. So have a robust strategy, which work through all parts of the market cycle. Yeah. That is the only thing you can control, and that's what we talk about in our meetings a lot, because when things are really good, we don't get overly excited, because it's fine, it's part of the cycle. When things sound bad out there, we don't get overly down because to us it's all expected.
And I think that's why, for years we've talked about realistic worst case. And you know what, in 25 years, I've never had worst case, and certainly the media will promote, massive uplift, massive, drops. But actually what tends to happen is, a little bit left of center, left or right of center. It's not these massive swings and that, even though the media will present that as being, that's what's happening. But it certainly hasn't been in my case. I mean, prices drop 10%, 20%, and they come back, but I still get to hold the property the whole way through, And the question really is, and what I've found is, for most people, if you don't manage that cash flow, that's the real thing, that's the real issue. If you can't pay your mortgage and that sort of thing. But the one point I will make is, this is a big change that I've noticed over the last sort of decade is we used to say the biggest assumption was that property doubles every 7 to 10 years, And effectively that used to be the mantra, that was the mantra that I was taught, that was the mantra. And to this day, that is still correct, The difference is, whereas I used to say it was on all property, you could buy a property anywhere and it would go up. Now, I think you've got to put a massive asterisk, and really that asterisk is, now that only happens where the best fundamentals are, And what do I mean by the best fundamentals? I mean shops, schools, transport links, major employers, major investments. Hopefully, if you've been watching me for a while, you've heard that mantra, you've heard me say that many times. But the actual thing is we do it the other way round, because shops have the least impact. Major investment has the biggest impact. Major employment, major transport, schools and shops. That's the order that you actually do your research and the impact by. So the biggest impact is in investment. And, if you understand that, then when you choose a property, or you don't forget the property so much, because you can actually renovate a property. So you can take a crappy property and turn it into a good property. But I think that the key to this with this is you can't change an area. So what you do is you pick the best area, and then you find the property within that area, and whether that be whatever strategy. It could be a new build HMO, it could be a student, it could be whatever, It could be off plan, it could be, anything, But the area is the key determinant of those fundamentals. And so you as an investor, you can't change the fundamentals yourself, And I think that's one of the key things here is you're not big enough, you're not influential enough to go into an area and say, I'm now going to turn this crappy, crime-ridden area into, the place where, Hollywood Hills, it's just not going to happen. But what you can do is you can go to Hollywood Hills and take the worst house in the best street, renovate it, and make money. or you can take an area that's getting massive amounts of investment into it, planned investment and money behind it, and you can buy an off-plan property that completes in 3 years' time, and ride that, investment up, And I think that's one of the key things. One of the things that we're really good at, and it's one of our strategies that we've worked for many, many years, is regeneration. So we talked about that major investment as being the key. You go to an area that's being regenerated, okay? And it's got to be a big enough regeneration. It's not just about it's a new building. We're talking about, substantial change in that area. And, so maybe, do you want to run through, talk through an example, mate? Ritesh?
Yeah, so it's good because moving on from the regeneration topic that Brett's talking about, that's something which really excites us, and over the last 15 odd years, that's pretty much the model that we follow. Get into an area which is a 4 or 5 out of 10, and then do your research and see that there's changes that are going to happen, which is going to turn this into a 6, 7, 8, 9, 10 out of 10 area. Because if you can pick out those areas and get into them early, from our experience, that's where you make the biggest uplift in prices, the biggest return on your investment, which is ultimately what we all want. So these are actually two great examples. They're both projects which we got involved in, back in 2010 at the early stages, Royal Arsenal and Kidbrooke Village. And they were both regeneration. I actually had clients at the time, when we were selling a bedroom unit, back in 2010 for 180, 190, who even at that point said, Ritesh, are you sure a 1-bedroom unit in this development at 180, 190 is not overpriced? The reason I said that is because you could find run-down second-hand properties in these areas for lower. However, research and all that kind of stuff, the changes that we knew that were going to happen, we were still stubborn to our belief that yes, this is still an investment. And a lot of the clients said, okay, I'm working with you guys, and you want to help me build my portfolio, you're going to help me, so let's do it. And if you look at the timelines now, up to 2018, and you can, pretty much most developments, values have doubled in price. Okay, between that. Now, what's more interesting? Okay, they've doubled in value. Why have they increased in value? And done well. Well, there's a couple of different reasons. I'm not going to take credit for the market. The market does. We don't control it. Yes, we've got to understand it and set the right strategies based on the market, but that's out of our control. What we do control, though, picking out the regeneration areas and doing our research on what sort of change is happening in this area. We knew in both cases that Berkeley Homes were committed not to just building a block of 10 apartments or 100 or 200 apartments. They were creating a village. They were building a community in these areas. And within the developments, they were going to put schooling, commercial facilities in there, you name it. Everything that attracts population to land was going to be built on these sites. And what that is going to do is create exponential demand.
Yeah.
Okay, prices, the demand is going to go from there to there, and that's where prices move the quickest. It's great to actually live through some real life stories. And guys, that's just 2 examples. I can reel off 7, 8, 9, 10, 12, the examples can keep coming. But these are just, for me, very good examples. If you buy property in regen areas with the right developers and hold them, what's possible to be achieved.
Yeah, 100%.
Yeah.
And I think that, it really has, and it's been a strategy that we've been working for quite some time. And look, major investment makes a massive difference, and it doesn't guarantee you, success, but it certainly makes it a lot more likely. Okay, and we've proven that. In fact, we've proven that same model pretty much there. We've done 7 different times in London, just in London. And we've done it various, times all around the UK for, the different places we operate. But so let's break it down now. So we've talked about best fundamentals. We've talked about, property doubling. Now, I don't think, forget about the doubling side now, because actually I don't think that's by any means guaranteed. But the point is the places that are likely to go up are in the best areas. And so if you can move to the best areas, and so what we have is what's called the ripple effect pentagon, which is how we source property effectively, and we know where to. And what we do is we look at the market and we look at where prices are or have just gone up tremendously, and we don't invest there. because what you tend to find is when something goes up a lot, it then sits around and be stagnant for a while. Okay, so London had some massive growth up until 16, and so London has really been sitting around not doing a lot since 16. Now we're actually getting back into London. But if we have a look here, so zone 1 and 2 is the best fundamentals. So that is the area to invest if you can afford it. If you can't afford it, go to zone 3, 4, 5. If you can't afford that, commuter towns outside London. If you can't afford that, major cities with universities. If you can't afford that, major towns. Now, for the major towns now, my challenge is that I'm not sure they're really the places to invest, and we'll talk more a bit about that. But so this is great for, this ripple effect Pentagon is great for strategy, because what you can do is if you start off at your London zone 1 and 2 and say you invest there, great. And then when the market gets too high, you then move to 3, 4, 5, because that's the ripple effect. And that's what we talk about, the ripple effect Pentagon. Yeah. And, effectively the major cities for me right now are more like your Manchesters, your Birminghams, your Liverpool, maybe your Leeds, and a few of those ones there. But your major ones are where things are happening, and we'll talk a bit more about those. But look, in terms of let's talk London for a bit. And for me, London is London property. Look to the setting sun, and what do I mean by that? Well, I mean look west. For many years, okay, we were actually investing in effectively East London. So those, Kidbrooke and Royal Arsenal were in East London. So let's have a look. This is a map of London now, and this isn't all of the places where stuff's happening, but I just wanted to give you an idea. So I'll let you chat through, Ritesh.
Yeah, no, good. So, these, like I said, are some spots that we are seeing, a lot of regeneration and change happening. And remember that word, regeneration and change, okay? Back in 2010, when we started getting involved in the London stuff, it was all east and southeast. Simple reason, geographically well located, but you only live there if you couldn't afford to live in other parts. That's the reality of it. But then the government started investing a lot of money in, started working with the big developers, putting transport lines up, building big developments, and improving the style of housing that was available to live there. So all of a sudden, what you saw is the biggest change, and all of a sudden, prices move there exponentially. What I'm starting to see now is that yes, there's some there is still stuff going on in the east, but I'm seeing more and more stuff starting to happen in the west and the northwest and the north. Okay, so it's almost like not much was going on there 10 years ago, but now that's all beginning to kick off. In fact, some of it's already kicked off. So if we talk about some of the areas, you've got Colindale, for example, which is sort of northwest London. You've got 10,000 new homes being built there, High Street being upgraded. You've got new schooling, new health facilities. So the fundamentals are getting stronger. Okay, another good sign, that an area is primed to go up in value is when the big developers come to town. Yeah. Okay, so your likes of Berkeley Homes have built a huge scheme there. Galliard are there, Redrow are there, Fairview are there. Me and you might invest in a property or two property there. These guys are investing millions to build these developments. So for them, they do a hell of a lot of research of are these the right spots. So when you do tend to work with these guys, I'm not saying they're always going to get it right, but they're very likely to get it right, is what I'm saying. So it's always good to ride on top of these guys. Colindale, then you've also got the Brent Cross Cricklewood regeneration scheme as you go up. That again, there's about 27,000 new jobs to be created through the expansion of Brent Cross Shopping Centre, which is a pretty big scheme. You've got 4.2 million square foot of office space being created. We'll have to see how much of that is going to be used or if any of that changes with COVID and work style, but it's still there. There's about 419 million on the railway project for the Thames Link, so it will take you from Brent Cross into King's Cross in about 15 minutes. Yeah, if you can cut down journey from your home to key places of work and play, as they say, then prices are massively going to go up and rents are going to go up. Why? Simply because again, there's going to be more this. There's going to be parkland, the new high street being created. The list goes on. Another area to keep your eye on.
Hey, Ritesh, maybe just, I think you need to talk. I think you're blowing out your mic.
Oh, really?
Because we're losing you. Yeah, don't talk with so much passion, mate. Try, yeah, you're right. Oh, here we go. Oh. Nah,
How
that's...
does this sound?
Oh, that's... Yeah, try that. A little bit better.
Is that...
Nah, it's not.
I've got a technology team here. They're trying to fix this problem.
Nah, it's no good.
Okay, that's not
Put the other one on, but maybe don't like talk as loud into the thing. Sorry, guys, we're having a few issues here. Anyway,
sound, guys?
Yeah, just try that.
Are we good?
Yeah, don't know. Anyway, let's keep going. Yeah, so London. I mean, you know, I don't think you can fold it. So where else then? You there? No, you just muted yourself, mate. All right, so unmute yourself. Ritesh, unmute yourself on the screen. All right, I'll start talking and then he can come on when he's ready. Look, guys, so other areas, you know, we've got White City. So if you're looking at a zone 1 sort of place, zone 2 place, you know, that sort of central area, White City, massive amount of stuff happening there, you know. And it really is that, you know, that is West London, you know, just on the outside of it. So yeah, so, you know, you've got huge stuff happening there, huge development. That whole area there, you know, is just getting totally revamped. And, you know, this is an area, I mean, when I first moved to the UK in 2002, I lived in Earls Court. You know, it was called Kangaroo Valley back then. And, you know, so, you know, it's amazing to see what's happening. But I tell you, the prices aren't cheap anymore. You know, it would have been nice to get something back in 2002. But, you know, then we've got things like Southall. Are you back on, mate?
Yeah, how's it sound now? Any good?
Yeah, okay, yeah, fine.
Is it clear?
Yep.
Good. So yeah, we're starting to see that sort of shift towards the northwest, and if we sort of move on and pay attention to Southall, but I mean, that's another big regeneration area now where Berkeley Homes again are building on 88 hectares of land. Again, this is not just a development. This is going to be a village. Okay, so you're going to have about 4,000 new homes that are going to be built there over the next 20 years. You're going to have commercial space, schooling again, coffee shops, the plans for a cinema, a gymnasium. So again, you know, and this might sound like a bit of repetition because it's a simple case of that's exactly what it is. You know, regeneration, all these things. So about getting involved in these areas where, you know, big developers are creating a community. You know, you've got the Crossrail there. The station's all going to be upgraded, and that will connect people from West London in towards Central London through to the east of London in very short spaces of time. You know, there's a saying: if you cut, you know, 20 minutes to 10 minutes, from 1 hour to half an hour, whatever it may look like, you know, those are the sort of areas that do really, really well. They're sort of tried and trusted. That model works.
Yeah, 100%.
Yeah.
And so moving out onto commuter towns. You know, I mean, it's interesting with the commuter town side of things because I think what we're starting to see now is lots of permitted development schemes, PD schemes, being built out in the sort of, you know, the commuter towns. And, you know, there's a lot of stuff happening out there. There's also a lot of, you know, housing projects as well. So, you know, it's interesting with, this is not just about London. This is about now outside of London. So it used to be, you know, we used to say, you know, it was all about zone 1 and 2, 3, 4, 5. You know, now it's about, you know, not so much the underground zones, but out into the Sloughs and the Watfords and those sort of places, which are all commutable into town. Now, you know, I think let's address the elephant in the room, which is that everybody's saying, you know, I know London's stuff now because nobody's commuting in, everyone's work from home, all that sort of stuff. It's interesting because most of our staff, by far the majority, and it was 80% last time we did the poll, they don't want to work from home. They actually want to work from the office. You know, they were desperate to get back in the office in lockdown. And I think as much as people are saying that, no, everyone's buying properties outside of the city and they're moving out, the reality is there's just as many people who want to move into the city, you know, because of the proximity. And make no mistake, a lot of the cities now are, you know, they're building in such a way where they're, you know, they're catering for, you know, people to live there, but people to commute as well. And I think that's where commuter towns are potentially a great opportunity. But yeah, what about, so we'll move on to sort of the major cities. UK now has 3 world cities for property investors. So what about you, Dan? This is your specialty. So what's your thoughts?
We've been focused on the north and UK cities for probably about 3-4 years. Like you mentioned, in 2016, London started to slow down. So yes, there's some great regeneration areas and pockets of opportunities in London. But what we felt back in 2016 was where London had gone through a galloping stage. Funny enough, the rest of the country had actually stood still since the last recession. If we go back even further, looking at the biggest assumption in property, doubling in value every 7 to 10 years, it had followed that pattern for the last 50. Up until the last recession, whilst London pretty much carried on the trend, the rest of the country stood still. So that's when we started focusing on the major cities in the north, Manchester, Birmingham, Liverpool, Leeds, Sheffield. But the first 2 I mentioned, and what you mentioned there, Manchester and Birmingham, they're your mini Londons, they're your world cities. You can put them in that bracket now because quite simply, so much is happening there. If we look at the infrastructural changes, if we look at the transport upgrades, the job creation, and a massive part of this was the Northern Powerhouse Plan. We're looking at a totally different proposition. And if we put that next to the numbers involved, the sort of returns, because you've got a good balance of cash flow as well as the growth. It's that's why we're sort of so attracted to those cities. And in terms of the fundamentals you mentioned at the beginning of the presentation, Birmingham, Manchester, you're not just relying on the future. You've got fundamentals there today as well. I won't go through them all, but in terms of transport, you've got all the major. You've got phase 1 of HS2 coming soon. You've got the tram system in Manchester that works well. You've got lots of regeneration schemes, multiple £1 billion regeneration schemes, and the major employers that we talk about. For Birmingham, Manchester, we're talking about the caliber of PwC, KPMG, HSBC coming into Birmingham, and in Manchester we've recently had Amazon moving in there. You've got the Chinese Business Centre by the station. We've always had the Media City, but not a lot of people realise that they're actually doubling that in size and investing £1 billion in that as well. So much is going on. But furthermore, you've also got a young population. You've got a big pool of talent coming from those world-class universities. And historically, people would get their degrees up in the north maybe and go to the big city, London. But now the retention rate is very high. So we're seeing lots of demand for new build. And I think what really excites me the most about it is that both have tech centres and, the tech industry, the fastest growing one. And they don't just have tech sectors, they have growing tech centres. And if we look at where the world's going, tech is pretty much taking over. And I think COVID has accelerated that process.
Yeah, 100%. And I think the interesting thing with the whole tech thing is people, when the last recession hit and the banks were decimated in terms of, all that sort of stuff, and, there was all sorts of, pressure on them to, to not have a collapse effectively. Everyone was talking about how Canary Wharf's dead, everywhere's dead, we've lost our banking sector, our finance sector. Well, you know what? What happened was over the last 10 years, we've built up this massive tech centre where really London and Manchester and even Birmingham are now, they're massive tech hubs. They are really, London is a tech centre of Europe, and that's happened almost in the back rooms quietly without anyone realising it. But now, it's a force to be reckoned with, and that's great. And actually, when you go to Manchester or Birmingham now, it's amazing to walk around there. I haven't been to Liverpool, but I know with Manchester and Birmingham, I was blown away. I used to run seminars up there every sort of other week, and and then I didn't go there for 10 years. And when we started to get back in, I was blown away with it. So yeah, but
Manchester is actually the fastest growing tech city in Europe in 2019, the fastest growing in Europe. So double its investment to 181 million.
Yeah, extraordinary.
I think what's exciting about it is
you've got the Silicon Valley itself's got 6,000 tech firms employing 38,000 people. So, and I think the mayor's committed to creating 29,000 digital and creating jobs in the next 10 years, which will sort of boost the economy by 8 billion. So much going on. So it's not just here and now. You've also got the future as well, I guess.
Yeah. Just had actually, we'll just break away. So we've got a question in from, I thought it'd be a good time to get this. So basically it's, is there regeneration going in Nottingham? Absolutely there is. I think is it Island Quarter I think it's 650 million Island Quarter or something in Nottingham. Look, there's all, in most of the major cities, and when I say major cities, I'm talking about ones with universities. Now the universities are going to take a hit, and that's to be expected. Certainly if you're in student accommodation, you're taking a hit right now. But that sort of thing, that is going on right now. So yeah, most of those cities have regeneration happening. The question is it big enough, or is it just one project of a small little part of the city and that sort of stuff? And so we haven't done a lot in Nottingham for quite a few years actually. Mainly because it's just there's too much going on for me personally. It's Manchester and Birmingham and Liverpool and those sort of bigger cities. But that's not to say that you can't the Sheffields and the Leeds and the Nottinghams and those sort of guys, even to a degree in the Lincolns, sort of thing, which obviously we've got an office there. But so Alan, cheers for that question. So yeah, but I think the other side of it is we used to have in the Pentagon, major towns with more than 100,000 people. But my concern with that is, if all the youth move to the cities, what's left? And that's my concern realistically is, look, for years, when we first started, we started in the suburbs and we started, the cheaper stuff and all that sort of stuff. And we've built up to be where now we sell, $600,000, $700,000, $800,000 property or pound properties in London, down to, your £100,000 properties in Liverpool and that sort of stuff. So, but for me, the key here is about fundamentals. So forget about where it is. It's about where are the best fundamentals. So, if you can only afford a £60,000 property, then get a £60,000 property in the best area, that you can, because that's more likely to go up for that area. But the challenge I have is there's a lot of areas that are getting no money pumped into them. And they're the areas, it doesn't matter how good the deal is, how much discount they offer, how much, incentive they say, it's just not worth buying there, because everybody is moving out, they're moving into the cities, or they're moving into the commuter towns of the cities, and that's where you want to be investing, So yeah, look, the other side is, deal hunting without a proper plan. So we'll move on now. So what's the solution? Where do we go from here? So really, deal hunting without a plan is like jumping into a river of piranhas and cutting your leg off. It's a ridiculous notion. Unfortunately, this is what most people do. Okay, most people come into the industry, and if you're starting out right now, I warn you against this. Yeah, you sign up to 100 different websites or 10 different websites, and you just get bombarded with deals. Have we got a deal for you? Because that is what the industry teaches. That is real estate 101. It's about urgency. It's about getting that person. It's a scarcity mentality. It's the worst thing you can do is to go deal hunting immediately. One of the things we talk about as a business is we talk about get a plan, get a strategy, and with those two things, and make sure that strategy meets the market. And when you do that, it's amazing what you can get and the level of certainty you can get. Understand the rules of the game and all this sort of stuff, because that actually is the way to invest in property. And really that is what you 100% have to do. So I think, for me, the first step, is don't go deal hunting. Don't go looking for hundreds of different properties to buy, and try and make a decision on whether it be students or HMOs or, off plan or new build or whatever it is. Work out the plan. And the plan is, where do you want to go? Where are you starting from? How are you going to get there? Yeah. And then you get a strategy that meets the market. And what I say about that is, there's thousands of ways to make money in property. You need one, maybe two. Okay. And I really mean that. I know guys that make money out of property that I have no concept of how they actually do it, but they know their game really, really well. I know my game really well. We know our game really well, and because we know the rules that apply to the game, we make money consistently, and our customers, our clients make money consistently. And I think that's really, really, important and you get bombarded, and unfortunately that's just the name of the game. You got to learn how to filter that out, get a plan, and then that way, once you've got a plan and strategy, you don't need to be bombarded with all the sort of, this opportunity, that opportunity, make this much money. At the end of the day, the best way to make money is to focus, get the rules of the game, and really get to know that, and that's the best way to do it. The other side is, that you need to do, property is a box that makes you money, yeah? And it's a mentality, but it's an approach, and it's where you need to get to. You've got to get a good level of education, so, not an education specific to your approach or your strategy, okay? And this is absolutely key, because so many times, and I talk about a disciplined approach, because I find most people are very undisciplined. Somebody pitches them a deal and says, this is a great idea, no, forget that, you should be doing this, and guess what? They go, this way, and then somebody else is there, and they're this way, and they're all over the shop. And the problem is, they may buy one or two of those properties and then work out they don't really understand the rules that apply to that game, and it can be tragic, and it can knock you back 10 years, because think how long it takes you to create that initial seed capital. You've got to protect that, and really part of that, the box that makes you money mentality, is about taking the emotions out of the decision and putting in the numbers and understanding how the numbers work and doing the due diligence and all those sort of things. And that's all the process that obviously we help you out with, and that you need to do. And especially now with recession and disruption and all this sort of stuff, you have to do it, and you have to get that squared away. So the other side is I've realised that I just put the wrong screen on. Did I? Hold on. There. No, it wasn't that one. I must have stuffed up the thing. Anyway, sorry guys. So bottom line is with this is, no, I'll go back because I've forgotten the thing. I had the wrong thing. Bottom line is, look, you have to, if you're going to do this, you've got to get a team around you. Yeah. So whatever you're doing, you need, a solicitor, you need a broker, you need a sourcer, you need all these sort of things, and this team around you. And now more than ever, it really, I remember back when I first started, I couldn't afford to have all these different people. So, I wrote my own mortgages. I did all the bits and pieces myself. I didn't do the conveyancing, sorry. But now it's absolutely fundamental, because there's so many peculiarities about it. Even managing the property. Look, I've got a property management business, and Ezytrac, that we have 1,250 properties that we manage. But there's so much detail that you've got to get into. I've done my level 3 and I'm now doing my level 4 just to keep up with the level of compliance and detail that is required. So you've got to get a team around you. Otherwise, it's going to end up costing you money. And, if you think good advice is expensive, wait until you pay for bad advice, or worse, not taking advice. And I think that's one of the keys. So look, guys, you've got two choices in how you build. You do it yourself or done for you. Yeah. And the reality is that for the most part, you may do some of the stuff for yourself, but that is going to become less and less now as you have to do more and more, or use, professionals more and more. So you're going to have to get your power team around you. You're going to have to get people, that advise you and help you. And obviously that's something that we can do, and it's something that we're, experience that in what we do every day of the week is, the done for you approach, where, you're busy, you don't have the time, you don't have the, potentially the relationships that you need, we can do all that for you. So if you're not sure, and I think, look, the reality for all this is, if you're not sure and you're not certain, then the best thing to do is have a chat with the team and just get all your questions answered. Don't rush into buying a property. Don't rush into doing a deal. That's not necessarily going to help you. Take your time, get it all squared away, and when you do that, it just makes so much sense, because, one of the statements that Ritesh made, which was 100% accurate, which is, people think property is complex, but actually it's relatively simple. And that's what we're going to do. We're going to make it very simple, but effectively take all the tasks away from you, and we'll use our team and, the professional. Any comments on that, guys? Before, actually, we'll open it for questions in a sec too.
Dan, any comments on there?
No.
I don't think my mic works.
No, your mic's working.
Oh, does it? Oh, brilliant. Oh, I'm there. I'm alive. Yeah.
Great. Hold on. What? No. Yeah, no. You're right.
Nah. Yeah. Now, look, if you're thinking, or have been thinking about doing something, look, there's always going to be reasons and concerns and, things that stop you, whether they be real obstacles or whether you're just making excuses to yourself. and that's sometimes what it can be. But the reality is, what I would say to you is sit down with us, go through everything in a lot of detail, go through your concerns, because we are happy to share all the risks involved in all this, so you actually understand, what good looks like, what bad can look like, but more importantly, what steps and systems can you put in place so that actually bad doesn't really look bad. It's just that you didn't have the systems to deal with it. Yeah. So get that plan formulated and then go away and make the decision. But what I was, don't sort of sit there and don't sit on the fence and don't do nothing, do something.
Yeah. Daniel, mic's on mute, I think.
Sorry, okay. Yeah, I think the main thing is that when you do make that decision, whether you're going to do property or do a bust, it's an educated one, because we all come into this with barriers, concerns, and all that kind of stuff. It's about understanding the upside, the downsides, the mechanics behind all the strategies, getting a clear picture of how it all works. And like I said, in the planning side, is strategy structure. So we make sure that we structure it in a certain way. So if you're concerned about interest rates going up, we structure it in a way where you've got buffers and allowances. So I think the main thing is to commit to exploring it and making an educated decision at the end of it once we've gone through everything in detail.
Yeah, 100%. And I think, guys, with this whole thing is, there's always, I always talk about the white noise, the TV screens that have the white noise all over it. For me, that is what you need. There's always the white noise. And what I mean by that of property is there's always some reason not to do it. There's always something in the background sitting there that says, oh, that's a risk. Yeah. You're never going to have absolute certainty. You're never going to know this is exactly right. You're never going to, you can listen to one expert, but another expert will tell you something different. And, the problem is, until you get to the point where you start asking questions yourself and you sit down with people and you work through, you'll realize that actually a lot of the risks can be mitigated. Now there's still risks and there's still downside and that can happen, but actually a lot of it can be mitigated, and a lot of it is actually emotions, and it's just getting your emotions in check. And you do that through education and experience. And one of the things I always say is, act as if you're buying a property and go through some dry runs with us. Go through cash flows, go through the area, do the research, act as if you're going to buy it. And you do that a couple of times. Sorry?
That's when the real questions and concerns come up.
100%. And you very quickly realize that actually there's always going to be COVID, or there's always going to be recession, or there's always going to be something in the background. And you just got to filter that out. You just got to filter out the white noise. Yeah, because for the most part, it's not actually going to affect you, and it's unlikely to affect you. And the bits that you know about, you minimize or you mitigate that risk as much as possible. And if it comes true, it comes true. You deal with it then. If the market changes, the tax goes up, this goes down, the other, that happens. You just deal with it. You roll with it, and that's part of the review process of the portfolio management we do. Is we're constantly reviewing, and we can review as often as you want. Generally, it's every 6 months, 12 months, 2 years, depending on where you are in your cycle, because property does move relatively slowly, But yeah, so let's get into some questions, guys. But look, guys, any questions you've got, you can type them into. Sorry about the webinar technical stuff, but I know YouTube's working and Facebook's working. So Simon, I've saved this one till now. So basically, what are your thoughts on how all these pending evictions is going to affect the market? Look, so there's two elements of this that I'll look at. Number one is, I'm not sure it's as bad as it's been made out. Okay, I don't think there is that, because of the government supports that were put in place. I mean, to give you an idea, we manage 1,250 properties, and we've got 3 that need to be eviction. One is taking place on Thursday. Fantastic. She owes about 50 grand. It's a whole thing. I'm going to write a whole story about it. She's changed her name 3 different times. I mean, it's just appalling. The courts have let her take it stage after stage after stage. She's supposed, anyway, I'm not going to get into that. But bottom line is, I don't think the number is as high as they've been made out to be. Okay, and I think a lot of it, the system has got together, and tenants and landlords have worked together. I think a lot of lobbying groups have made it a lot bigger issue than it may be. But that's not to say that if your property is having problems, that doesn't discount that at all. The reality is the courts are opened up now, and so things are starting to move, but it is going to take some time. And unfortunately, I don't think it's going to affect the market. It is only still a small portion of the market, so I don't see it affecting massively the market, but I do, if it's you individually having that situation, then yeah, it's affect you massively. And in fact, it could potentially send you, behind, because, 6 months notice. And, Paul Champolina, basically, he mentioned in one of his things today that he thinks it's the government's, the government are just doing the Section 21. They're just effectively phasing it out on the quiet side, which, is for me ridiculous. I think that they need to do a lot of things, but they're not doing. So I think there's bigger issues in the pending evictions. I don't think it's a big issue. It is a big issue for the individual, but as terms of the market and individual areas and suburbs and towns, I don't think it's a massive issue, because the level of support that's been given, a lot of the guys who had difficulty and lost their jobs actually have been supported through it by the government spending. So that's been quite good. But yeah. Guys, any other questions from anyone? That's pretty much us for, the bits and pieces. Look, we're here, so we've got 6 more of these, okay, and then 6 more subjects. And what I'll do is I'm actually going to I'll put it up on the website, and I'll put it onto the YouTube and put it in the links in the description too for the next things. We'll get the webinar software working, or we'll just ditch the whole concept of a webinar, software. We'll see how that goes anyway. But yeah, so any questions, chuck them in there now. And yeah, happy to answer them. Just let me go through and just make sure I haven't missed any of these. Lots of comments, but yeah. Any guys, have you got anything further you want to add?
No.
I just realised. Let me just see if I've missed anything. Yeah, gotcha. Oh yeah, so do you consider regeneration in Birmingham significant? Oh, wait then, let's not take that off. Or just hype? Will property prices go up in the near future for Birmingham? So, Afzal, what do I think about Birmingham? Look, for me, I love Birmingham, and I love, it's for me, it's doing what every world city should, and I call it a world city now, because if I look at the number of international investors that are investing into Birmingham, putting money into Birmingham, and for me it's number 3 on my list. London is number 1, Manchester number 2, and Birmingham is a close third. And really I could probably interchange the two depending on which day of the week it is. So yeah, I do think it is going to make a massive difference. What we're seeing is, the Bullring area now has, that's been quite well developed. And now what we're seeing is, stuff popping up all around and development sites. So it's probably, for me, the prices haven't grown as much as Manchester have. So I think they've still got way to go. So actually, for me, I think it's fantastic. If you look at Manchester now in the city centre, prices have grown, quite a bit. So now we're sort of moving out to the, well, not so much, but around here, Noma and that sort of stuff in Manchester. Those prices are probably, they're on the top end of the side. But the fundamentals are fantastic there. Birmingham, same. I think it's not. It's hard because when I first went there to Birmingham, it was quite a rundown city, yeah? And we're talking going back to 2002, so this is almost 20 years ago. But since then, we've seen it growing incredibly, and really has become a tech hub, a future city, city of the future, all that sort of stuff. And that's what actually good cities are doing now, is they're seeing where things are going and they're moving forward with that. So yeah, have you guys got anything to add about Birmingham? So, sorry?
No. Can you hear me, guys?
Yeah, we can hear you. Yeah.
Like I said earlier, Birmingham for me, it's your mini London, and there's just so much going on there, so much regeneration. So there is so much more scope for growth. We've already seen it perform so well over the last 2-3 years. If we look at where the prices are going, not they will catch up with London, but there is so much more of a ceiling.
Yeah.
Yeah, and I think it's two sides to Birmingham. So you've got the city sort of area, the central areas, which are obviously pretty mature, developed and stuff like that, where everything's already in place. But then you've got Digbeth, which is more about the future and things up and coming, and that's going to be 5, 10, 15 years. God knows, that will keep going. So if you're the sort of person who rather go into Birmingham but be somewhere which is it's ready, it's landed, then stick to places like Jewelry Quarter, for example. That's pretty ready made. If you're someone who wants to get in lower price point and back what's about to happen and happy to take the risk of change, then obviously places around Digbeth are very good. So you've got both elements to it.
Yeah. 100%. Yeah. So I think, look, we love Birmingham. We love Manchester. We love London. We love London Commuter, and some of you guys love Liverpool. I'm still not totally sold on it as somewhere where I'd want to invest, but I know there's lots of opportunity there, to be fair. That's my personal vendetta against Liverpool from about 20 years ago when I first started investing there. But look, guys, so some more questions in. So we've got from Abed, why is the property market still going up despite the current situation? So I think there's a couple of reasons why, and this is not just the UK, but this is actually a lot of property markets that are going up, the US, that sort of thing. We've increased the money supply by about 30%. Yeah, that liquidity has to go somewhere, and where is it going? A lot of it's going into property. Okay, but also we've dropped the interest rates to rock bottom. We've stimulated, various bits and pieces, at a base level, certainly in the UK. But not only that, with the UK in particular, we've had austerity layered with Brexit, so things have been, kept down. And all of a sudden, Boris has come in and said, no, we're getting rid of austerity. We're now doing stimulus. And as well, people have got a decision whether you're for or exit, against Brexit. It's the fact that we've got one way, overwhelmingly one way, just almost said, everyone went, thank goodness. And so that's what we're seeing. And everyone went, thank goodness. And then COVID hit and it was like, But so now we've had it drop up, and that's the reason why, we're seeing that's still increasing. But things will slow down now because we're coming into Christmas. You're not going out. It's not as lively. All that sort of stuff. Plus we've got second wave and things like that. So, let's see what happens over Christmas, and then we'll see what happens with the spring bounce next year. Sorry, mate, you were going to say?
No, I was going to say on that point about the property market going up. You've got number one, you've got the pent up demand because we've been into lockdown for 4 months. And during that time, it was a complete shutdown, so there's no contradiction of supply and demand. And that coupled with the stimulus, like you said, the stamp duty, that with the pent-up demand together is what has seen sort of prices or transactions keep going to a high volume, and therefore that's why the prices have been going up as well. Yeah,
100%. Yeah, cool. And then we've got another one here. If Bank of England introduced negative interest rates, how will that affect property? More lending by banks? I don't actually think that negative interest rate is going to affect. So first of all, I don't believe if we go negative interest rates, most mortgages now have a collar. In other words, they won't drop below. So it's not like you're going to get negative interest rates. So I think the positive effect on cash flow for us as individuals is largely done and dusted now. So that's not going to change, I don't think. Yeah. But what it does do is it gives the banks more margin, and when it gives the banks more margin, then they're more likely to have cash to lend, and I think that's where that will assist. More lending by banks. Look, the challenge is that unless the government mandates, like with a CBIL loan or a bounce back loan, and says, we'll underwrite your risk, they're not going to lend. They're not able to take the thing, because the problem is it's too easy for if someone defaults that they blame the lender. You weren't responsible lending. On the one hand, you've got Boris saying we want 95% mortgages, but on the other hand, they're saying responsible lending. Well, in Australia, one of the things they're looking to do is they went responsible lending, clamped down, and then all of a sudden they went, that's a little bit too much. No, we'll open it back up. And now they've said, no, we're just going to write all that off and you can lend whatever you want. For me, I'm a free market man. So I'm like, if a lender wants to lend under whatever circumstances, as long as it's not, it's ridiculous lending where they can't lend back and you're basically stealing from them, then fine, let them do it, but we'll see. Any thoughts for you guys? Negative interest rates?
No, I mean, pretty much what you said there. I agree.
Yeah.
So the main thing is, like you said, the banks. If anyone thinks so, they're going to be borrowing money at zero, negative interest rates.
No.
They've got that in the contracts. Not happening.
No, that's right. No, exactly. So Alan, another one from Alan. There's talk of CGE's capital gains tax increasing in the US if Biden gets in. Have you heard any potential CGE increases in UK? Yes. So I think capital gains tax potentially will increase because at the end of the day it's a tax on profits. That are actually realised profits. So I think that is one of the stings in the tail, is because there's almost this spending. Somehow we've got to pay for that. Now how do we pay for it? We pay for it by the economy growing. But let's face it, if everything is, if we go into stagflation, that's not really going to happen. How are they going to pay for this? But the thing is most countries are doing this now. Most countries have done massive stimulus programs, so they've had to borrow for that. The challenge is that could mean that for 10, 20 years, who knows, it could be subduing things. So rather than having these wild, rides, we may see that it's more of a, like this now. Who knows? It could bounce back, and I think this is where London. I think my gut feel is that London is going to bounce back next year, and that's why I'm quite bullish on London next year. I think even though affordability and all that are issues, I just don't see that necessarily being a massive issue. But I think unfortunately taxes will be going up because the governments have to pay for it somehow, and how they're going to pay for it? Well, they're going to pay for it any way they can, and unfortunately, the capital gains tax is an easy tax to raise, So, any thoughts on that, boys?
I mean, all I'll say is that with things like taxes, there's always a chance, that they're going to. We're talking about CGT. Yes, today it's that. It could be income.
Yeah.
Fine. You've got to know it. You've got to understand it. But I like to sort of focus on let's get into a position where we're making money to be thinking about tax, and then use professionals in that field like accountants to structure you in a way where you're paying your taxes, but you're set up tax efficiently. I just find sometimes, or too many times, people are worried about the tax before they've actually made the money. So yes, have your eye on it, understand it, know it, but really keep that focus on making that money.
Yeah, 100%. And at that, if make the money and then worry about the tax. Most people worry about the tax, and that's not ignore the tax before you make money, but most people spend so much time worrying about paying tax before they've even made any money. I'd rather them spend the same amount of time they worry about tax into actually doing research into the area and into the property and into the deal and the cash flow and all that, because that's going to make them infinitesimally more money. So we've got another question from Dave. If you're renting and your rent is reasonable, but you have 30, 40K savings, would you say it's better to buy a place to live or to use the funds to purchase a buy-to-let investment? I think it's really two. It depends on what's your partner. If she wears the pants, then you probably won't. That decision will be taken out of your hands. No, I think, look, it's always great to have somewhere to live, but financially, actually, a lot of decisions, a lot of time, it's better to invest and actually rent somewhere, because you can rent cheaper than you can buy. As long as that 40 to 50K or 30, 40K is going into an investment, and working for you, then for me, that works really well. But by the same token, if you're settling down, having kids, doing all that sort of stuff, having a place of your own, is always, it's an inspiration, and it really does. It's a motivator. It will, help you, because it's going to make you money anyway. So for me, it's not a this or that. It's depends on your situation. What are your guys' thoughts? Any thoughts?
We actually have quite a few clients who are renting and actually decided to take the step with investment first.
Yeah.
And one of the first things I always ask is, where you're renting now, are you happy there? Have you got the space? Is it the right place, for your work life, your personal, your social life, all that? And if the answer to that question is, it is, and we love being here, or I love living here because it really works, and I'm like, fine, invest. If the answer is no, where, the place that I'm
renting. I'm not happy, you know, whether it's the condition of the apartment, the location's not right, you know, and it's making someone on a day-to-day level, you know, not too happy. Then the reality is, look, go and get yourself a place to live first. You know, because you know, it's all about getting that balance right.
Yeah. And I think it's a massive motivator. Once you get, I always talk about stretching when you buy your own home, because if you stretch when you buy your own home, it's amazing how 6 months after buying it, you will adjust your lifestyle, and that will just become an easy payment. But one of the challenges is if you don't stretch and then you settle for and you buy a place, then you feel stuck, and then you feel like you made the wrong decision, that sort of stuff. It's amazing how the brain will expand, you know, the mind will expand to, you know, to meet your surroundings. So if you're more, you know, you think, oh, you know, my mortgage at £1,000 a month is a stretch, there's no way I can afford that, you know, and yet you do it at 1,100 and you're like, oh, I don't know how I'm going to do this. You'll find a way and you'll sort it out. And I realize that, you know, from a strictly fiscal sense, that's probably bad advice, because you should spend within your means and all that sort of stuff. You know, I've seen so many people who, when they stretch, that just becomes their norm, and that just becomes what they can do, no problems, you know. So yeah, good. So guys, any other questions? I've got one more here, which is basically that. Do you expect, you know, buy-to-let market to be better for houses than apartments? Look, I think this is an age-old question that we get all the time.
Yeah.
Look, for me, it's a cycle. Okay, so what you tend to find is that apartments, okay, go through a period where, you know, when they're, you know, they may, you know, they'll go up in price, and then actually houses will be cheaper, and then what will happen? Houses will go up in price, you know, and it's a bit like this, you know. Look, they serve a different type of the market. You know, generally your city centres, which your best fundamentals, all that sort of stuff, will be your apartments, and out in the suburbs will be your houses. So it just depends on what you're looking for. They both make money. Yeah? And if you buy them well, you know, they both rent, and, you know, so it's not a case of houses are better than flats, even though a lot of people say, oh, no, houses are always better than flats. You know, I've done both. Okay, so yeah. But yeah, you know, so I think, and actually you mentioned that was in Birmingham that you're seeing lots of apartments. You will see apartments in Birmingham, because that's what's going to be built. You've got to realise that, you know, the population increases, and as the population increases, there's going to be more apartments built, and taller apartments. I mean, there's 20, you know, massive story apartments, skyscrapers being in planning now in London. London's going to become, you know, a futuristic city where you see, you know, all these, you know, massive, you know, high rises, and that's happening. That's happening in all cities, and Birmingham and Manchester and all those places will be the same. You know, so,
whether it's that house or flat, it's ultimately the land value where you're going to make your money. But just on that point of the city centres, there's limited space. So when developers go into these appreciating city centres, if there's no space to build houses, there's limited land, so they have to build upwards. Yeah, that's why you just won't see houses being built in city centres and surrounding areas. Just won't quite happen.
Not at all. You know, so yeah. Guys, that's all the questions that I can see on the streams. Now, I haven't actually seen any from Facebook. Oh, yes, I have. So yeah, so we've obviously got some Facebook there. So that's good. So look, guys, any questions you've got, if you're watching this and it's not live, then just go to webinars@gladfish.com, and we'll be able to either, I'll jump on and I'll record a video on my social media channels, or I'll send an email back to you, or I'll quickly type one out. But yeah, guys, you know, I want to thank you for joining us, and Rit and Dan, you know, thank you very much for your contribution. And yeah, guys, look, really appreciate. Don't forget, subscribe. You know, comment, you know, whatever you need to do, any questions, anything that can help you through. If you want to chat to the team, you can give them a call. I'll chuck that on the screen in a minute. And basically, yeah, look, we've got this now. Oh, hold on, we've got a new one coming in. Oh, two more. All right. So we've got recently come across an article saying that rents down by 20% in London. Landlords are finding it difficult to find tenants. Will it bounce back? Anyway, I think that's a really good question, because actually that is one of the concerns. We haven't had 20%, not 20% drops. You know, we're getting probably 5%, 3 to 5% sort of thing drops in London. I think that the big distinction here is, if a lot of your block was service apartments, those service apartments are pretty much decimated now. They're being put back onto the market, and because of that, you know, your apartment block, which may have had 50 apartments, but only 20 of them are long-term let. Now you're competing 30 all of a sudden. It will come back, yeah? So once that slack has been taken up, then it'll start to grow again. So, this is a seasonal, situational thing. Once it's fixed, it'll be fine, So I don't think you need to worry about that too much. Yeah, obviously if you've lost 20% of your rent, that is, devastating. But, the reality is I'm not seeing 20% down on any of the stuff that we're doing in London, at all. I think, and this is where I think the media, they'll hear one property and that becomes look, 20% drops. We're just not seeing it. I mean, and we've got, I think, 700 or 800 properties in and around London that we manage, so to not have any real, 20%, 3s, 4s, 5%, there might be a few that it's a bit more, but it's not that drastic, but yeah. And one more, so we'll take this as a final question. So what's your advice for new generation to get their foot on the property ladder? Awesome. Look, Naved, what I would say is this, yeah? Demonstrate you can save by saving 5% of the deposit. And once you do that, there'll be a scheme, I think, where you'll be able to get into a property, and whether that be Help to Buy or whether that be the new 95% mortgage that Boris has, said, there's a way on. But that's 5% for me gets you on the ladder. That shows that you've got the disciplines, savings, and the organisation to do that. And I think that's one of the key things, is to get that under your belt. And the other side is that don't sit there and say, well, I live in in Earl's Court or whatever, and therefore I need to buy in Earl's Court. You may have to go out to Watford or Slough or somewhere like that, and buy there as your first house and travel in, But don't worry about it, because wherever you buy, whatever you can afford, buy the best, in that area, okay? And I think that's the key thing, Get educated, read lots about, about property and all that sort of stuff. And don't get sold, take your time, because look, the best deal, the whole sales process is we can actually make any deal look fantastic. Yeah. And when I say we, I mean we as an industry. That is what we do, cute or, quaint little flat means bloody small, too small to live in, But, you've got all these, there's a whole different terminology. Now, to be fair, we don't play that game. You'll find, I'm no bullshit, no hype and all that sort of stuff. I just swore for the first time, I think, tonight. How about that? I did well. But no, look, I think it's the best thing you can do. Stay focused on doing it. If that means you can't go out drinking for 6 months, do it, because once you get that first property under your belt, it will change your life. Yeah?
Yeah.
Cool, guys. Well, we'll leave it there. Any other questions after this, by all means, send them in and, we can address them. But guys, thanks for coming to the first thing. And I hope to see you at the next 6 webinars that we're going to cover. There's some really cool topics that we're covering, everything from, the next week is kings, queens, landlords, and pawns. Yeah, it's, how to, stake your claim in the new world order. And I think that's one of the, what I'm going to look at is just how things were and where things are going, and how you can actually stake your claim and make sure you're one of those landlords, or the king or the queen, which obviously the new terminology is billionaire, so that's really where you want to be. So we'll talk through how to do that next week, and we'll see you same time, same channel. I'm not sure we'll be on the same channel with the webinar software, but anyway, we'll work that out. All right, guys, thanks very much, and Dan and Rit, thanks very much, guys, and we'll see you next week.
See you later.
Cheers, guys.
Good night.
See you later. Bye.